balance sheet is a black sheep because it doesn't want to be like everyone, to be a statement for a period of time. Figures marked by the word duration are everywhere, which means they are nowhere. The statement of financial performance, or whatever we call it, covers only a tiny fraction of the accounting flows. It moves us very little towards integrity and consistency. Such a table can also be called a statement. For example, a statement of changes in property, plant and equipment. The balance of stock is there, while the balance of flows is not. The fact that the financial reporting lacks a coherent set of all flows for the period does not mean the dynamic balance equation does not exist. Very few of the IFRS fundamentals go without a reference to a cash flow. These 24 classes of flows are neither equal to each other pairwise nor in any other local combinations. But if they are considered all together, they should be mutually balanced. Voila! This is the complete dynamic balance equation. The result of the accountant's work is financial reporting or financial statements. Is there any difference between statements and reporting? The statements in plural form sounds like a simple collection. Each statement is on its own. The reporting in singular form sounds like something integral, where each component is part of a single system. Let's try to figure out what is the backbone of financial reporting and what it lacks to really be not just a mere collection of different statements, but an integral being, so you can always confidently say which quantitative information is part of the reporting and which does not belong to it. If we take a look at the financial reporting content in the search for consistency, then immediately statement of financial position catches the eye. Its classic name, the balance sheet, speaks for itself. That's where the core is, the equality. The left side is equal to the right side. Resources are equal to claims. Meanwhile, the main feature of the balance sheet that distinguishes it from other statements is the temporal dimension. As the conceptual framework for financial reporting says, paragraph 3.4, financial statements are prepared for a specified period of time, reporting period. Are they really? No, not all of them. Balance sheet is a black sheep because it doesn't want to be like everyone, to be a statement for a period of time. And it can't be. The balance sheet can only be a statement for a specific date. It always reflects the financial position of a reporting entity at a particular point in time. You all know well from the economic theory of the concept of stocks and flows. So the balance sheet is a statement of stocks, while all the rest of the financial reporting, it's all sorts of reports on the flows. According to the objective of general-purpose financial reporting stated in the conceptual framework, Chapter 1, financial reports provide information about a reporting entity's economic resources, claims against the entity, and changes in these resources and claims. Speaking in terms of stocks and flows, resources and claims are stocks. They are accounting statics, and changes in resources and claims are flows. They are accounting dynamics. In this regard, the extensible business reporting language, XBRL, distinguishes two period types for all financial reporting figures: instant or duration. Resources and claims have instant period type. Changes in them have duration period type. The IFRS taxonomy marks all accounting stocks by the word instant and all accounting flows by the word duration. We could call the balance sheet the statement of accounting stocks, the report of accounting statics. And this report, being a black sheep at the same time, is the best sheep in the whole herd. It is perfect, the only perfect report in the whole reporting. The beauty of the balance sheet is in its completeness. Here are all the resources and claims without exceptions. All stocks, all accounting statics are presented in one report, figuratively on one page. Nothing is lost, because if some accounting item marked with the word instant is lost, then the report will not balance. The loss will be detected immediately. Unfortunately, only the statement of financial position has these advantages. What about the rest of the financial statements? There is anarchy, nothing close to what would be a system. Is there anything like statement of changes in resources and claims, anything like report of accounting flows? No. Where could I eventually find all this dynamic data in financial reporting? Hard to say. Figures marked by the word duration are everywhere, which means they are nowhere. Financial reporting is full of such data, like a hat of a magician in the circus. Such a huge pile of motley pieces of information. Take a statement of financial performance. What is this statement about? The ISB has been trying in vain to find a decent name for it, but all the options are still rather clumsy. A statement of profit or loss and other comprehensive income for the period. So far, it is not even possible to determine whether it is a single statement or there should be two statements. But that's not the point. Whether it's a single statement or two, it is or they are definitely about accounting flows. Unfortunately, not about all flows, but only about a small part of them. The statement does not concern changes in resources at all and characterizes the change of only one claims item. Truth be told, this information is very important because profit is the first thing users of the reporting look at. But now we are not talking about what information in the reporting is more important and which is less. We are talking about the integrity and consistency of financial reporting. And from this point of view, the statement of financial performance, or whatever we call it, covers only a tiny fraction of the accounting flows. It moves us very little towards integrity and consistency. A similar situation is with the statement of changes in equity. It characterizes nearly the same flows as the statement of financial performance, only in a slightly different context and with the addition of transactions with holders of equity claims, contributions from and distributions to them. Next, we take the statement of cash flows. The very name of it says that this statement is about the accounting dynamics. It contains duration figures. How much of accounting flows does this statement cover? Quite a bit again. Changes in claims it has nothing to do with. It characterizes the change of one single item of resources. Here we are. The list of so-called primary financial statements is exhausted, but accounting flows are not exhausted. Other changes in resources and claims are still presented in the financial reporting, in the part of it called very meaningful term notes. The situation with the presentation of these flows is quite bad. They are so scattered about these notes that it is absolutely impossible to see their general picture. For example, according to IS 16, Property, Plant and Equipment, paragraph 73, the financial statements shall disclose for each class of PPE a reconciliation of the carrying amount at the beginning and end of the period showing additions. This probably means the capitalized expenditures on creation of the new items and upgrading of the existing PPE. Assets classified as held for sale or included in a disposal group, acquisitions through business combinations, increases or decreases resulting from revaluations and from impairment losses recognized or reversed in other comprehensive income, impairment losses recognized in profit or loss, impairment losses reversed in profit or loss, depreciation, the net exchange differences arising on the translation from the functional currency into a different presentation currency, and other changes. Similar requirements are imposed on changes in almost every balance sheet item. Typically, such changes are presented in tabular form, and such a table can also be called a statement. For example, a statement of changes in property, plant and equipment. I draw attention to the wording of the paragraph that I have just quoted. The financial statements shall disclose, not the financial reporting generally, not the notes particularly, but the financial statements. Thus, a table showing changes over a period in PPE or in any other item of assets or liabilities is also entitled to be referred to as a statement in the financial reporting. However, there is discrimination in the financial reporting among the statements. Some of them are proudly called primary financial statements, and some are just statements. Of course, the statement of financial position, which is beyond competition, is among the favorites. But still among the favorites are those of the flow statements that characterize changes in money and in equity. Other statements on flows characterizing changes in assets and liabilities are deprived of the right to carry the title primary. I do not presume to judge whether it is fair or not, but anyway, the discrimination has led to disorder and vacillation in the ranks of non-privileged statements. Indeed, the flaws in the financial reporting are everywhere and nowhere. A small part of them is fragmentally presented in 3 primary financial statements, and the bulk of the flows presented in other financial statements in the form of scattered pieces summarized by the word notes, the total number of which no one knows and the format of which no one has ever tried to determine. Otherwise, as the word mess it can be called. Then let's see if you can put things in order here. How to make the flows in the financial reporting look as perfect as the stocks? Is it possible to bring the accounting dynamics into a balanced form similar to the statement of financial position, in which the left side is equal to the right side as well, and most importantly, from which nothing can be lost? In short, since there is a static balance for stocks, let's build a dynamic balance for flows by analogy. Thanks to this, I hope our financial statements will turn from a kaleidoscope of numbers into a truly holistic organism, showing a comprehensive picture of a business. It's really worth a try. But as opposed to the statics, it isn't easy. The entire accounting statics is accumulated in the statement of financial position. Such concentration of statics has allowed the statement to act as a basis for entire accounting. No wonder that such a coherent and solid foundation has become a starting point for the development of almost all accounting theories, including dynamic theories. Dynamic indicators are scattered across the statements. Their number is many, much more than static ones, not only by quantity but also by diversity. They are grouped locally and do not have a common integrative principle. Being scattered across various statements and notes, local groups of dynamic figures cannot be internally balanced. Income for a period is presumably not equal to expenses. Cash inflow is not equal to outflow. Contributions of the shareholders are not equal to dividends. Recognition of property, plant and equipment are not equal to their derecognitions, and so on. The wide variety of dynamic indicators and their dispersion across the financial reporting is a serious obstacle to build the dynamic balance. But an even more serious obstacle to this task is the incompleteness of accounting dynamics. Some of the changes in assets and liabilities are not shown in the financial statements at all. For example, any asset or liability that is not within the scope of a particular standard gets to the static balance sheet anyway, but other statements do not reveal its dynamics. Let's imagine, for example, that an entity acquires works of art beyond its core business. Its objective is investing. It tries to purchase them during the financial crisis when the prices of such items are falling, and sell them during the economic upturn when the prices are rising. The international standards do not handle the rules of accounting for such assets. There are no recognition, measurement or presentation requirements for them. An entity is forced to apply the provision of IAS 8, accounting policies, changes in accounting estimates and errors, on using its own judgment in developing an accounting policy, paragraphs 10, 12. But another thing is curious here. How will the information about such an unregulated asset look like in the financial reporting in the context of statics and dynamics? In this case, the static indicator is the carrying amount of works of art as of the end of the reporting period, not to mention comparative data. The dynamic indicators are the cost of items purchased during the reporting period, the carrying amount of items sold, as well as the extent of change in their carrying amount over the period if the entity's accounting policy provides for their revaluation. Note that the standards do not specify any requirements on inclusion of both kinds of indicators in the reporting. There are just general requirements for the financial reporting, IAS 1, presentation of financial statements, paragraphs 15, 46. So, this is the point where tacit double standards are applied. In real life, the static figures are included in the statement of financial position anyway. If the amount is important, the entity allocates a separate line to it and comes up with a title for it, such as investment in works of art. If the amount is insignificant, accountants do not forget about it in any case, finding it a place to be nestled in such as line other non-current assets. But what about the dynamic figures? It's absolutely useless to look for them in the financial statements in this case, regardless of the significance of the amounts. Even a meticulous auditor would leave this lack of the reporting unattended. Duration indicators are not merely forgotten. No one even thinks of them. Why ever are accountants so careful about the most insignificant indicators on the statement of financial position? Because omitting any of the amounts won't let them strike static balance. It is worth noting that neither IAS 1 presentation of financial statements nor any other IFRS contain a requirement to arrive at the balance. The standard features just a minimum list of items to be included in the statement of financial position. This is IAS 1 paragraph 54. Accountants are concerned about striking the balance just because this is what all their predecessors had been doing for centuries. This is sort of an unshakable accounting tradition that doesn't seem to need any regulatory requirements. It would be nice if a similar tradition had developed in relation to the accounting dynamics. But nobody has ever arrived at the dynamic balance yet. Therefore, the movement of such asset as work of art for the reporting period is not disclosed anywhere in the statements, regardless of how important are those amounts. Meanwhile, works of art are by far not the only gap in IFRS. The scope of the standards have not yet covered such objects as investment in bullion, advances paid, advances received, value-added tax, and others. You can be sure that the tacit double standards in relation to the instant and duration indicators will still be in evidence in financial reporting in respect of all such objects as long as the balance of stock is there, while the balance of flows is not. Moreover, the gaps in dynamic relate not only to the unregulated objects. Even the existing regulatory requirements for duration indicators are often random and incomplete. For example, the requirements of the IAS 2 inventories for the disclosure of information on the movement of inventories in the financial reporting somehow address only the derecognition and impairment. IAS 2, paragraph 36, DEF, but do not address any positive movements. Perhaps the authors of the standard imagined a user of financial statements as a kind of notorious pessimist who wants to see only the outflow and does not want to know anything about the inflow. I'm joking. It is unlikely that such selectivity of the requirements has legs to stand firmly on. Such shortcomings of IFRS occur only due to the absence of any basic principles for the existence of accounting dynamics. In such circumstances, bringing all the dynamic indicators presented in the financial reporting together is not enough to compose a dynamic balance sheet. However long we scrape the bottom of the barrels with all statements and notes, we are unlikely to collect enough flows from there to have the pans of our dynamic scales balanced. For example, if you dig all the duration indicators out of IFRS taxonomy, you won't be able to sculpt a balance equation from them, no matter how they would be grouped. This is because it lacks a lot of duration indicators. The balance sheet does not tolerate exceptions and omissions. Therefore, for example, the permission not to provide information, if it is not material, it is IAS 1 paragraph 31, as it pertains to the statement of financial position, is practically applied only to its structure, but isn't applied to the very presentation of the items in the statement. No one excludes the immaterial items from it. Similarly, you surely need every bit of accounting dynamics to compose a dynamic balance sheet. The fact that the financial reporting lacks a coherent set of all flows for the period does not mean the dynamic balance equation does not exist. Dynamic values can be mutually balanced, but only if they are all put together, not when arranged in local groups. Inasmuch as all stocks are mutually balanced, the changes in them must be mutually balanced too. Since flows are the changes in stocks, it's in the course of nature to build the dynamic balance sheet on the basis of the static one. It will prevent us from missing any dynamic indicators and make sure they are mutually balanced. In this regard, prior to building the dynamic balance, we need to refine the structure of the classic balance sheet a little. We need to divide resources into two parts, isolating money from other assets, the same way as equity stands apart from liabilities, dividing claims into two parts. This refinement is necessary first of all because the movement of money is reflected by a specific set of indicators, the cash flows. They are of particular interest for the users of reporting. In fact, very few of the IFRS fundamentals go without a reference to a cash flow. There is a specific classification designed for cash flows which is different from any other accounting classifications. There is also a separate statement within the financial reporting, specially intended for these flows. And the preparation of this statement is subject to a special accounting standard. Actually, there are many reasons why money should be separated from other assets in accounting, just as equity is separated from liabilities. But now I do not want to go into this in detail. We will assume that this separation is necessary, at least because, from the accounting point of view, money moves in a special way that is different from all other assets. I do not attempt to draw a clear borderline between money and other assets. The economic development has resulted in the multitude of monetary forms. A notion of cash equivalents used in IFRS has emerged, but this is a peripheral issue. It can be settled in various ways depending on the specific accounting tasks, the level of maturity of accounting methodology, and other factors. After all, the problem of indistinct separation of equity from liabilities is still on the agenda. This is a specific matter that had been settled differently at various times, even by the IFRS. However, the borderline uncertainties do not detract from the necessity for the very separation of liabilities from the equity. Similarly, the borderline uncertainties of cash equivalents should not detract from the necessity for the very separation of money from other assets. Let us agree from now on to designate common elements of the static balance sheet with the terms used in the IFRS conceptual framework: resources and claims. We use R for resources and C for claims. Our starting point, R, is equal to C. To isolate money on the left side, let's agree to narrow down the common understanding of the term assets. We will use this term for assets less cash and cash equivalents. Thus, we divide the left side of the equation into money and assets. M is for money and A is for assets. The right side of the equation is divided into our usual equity and liabilities. E is for equity and L is for liabilities. Thus, the equation is transformed to M plus A equal E plus L. Now we move from statics to dynamics. Each of the four elements of the equation changes during the reporting period. These changes are accounting flows. Of course, the differentiation of flows that is based on the changes in four basic elements of static balance, money, assets, equity, and liabilities, is too early to call a classification of accounting dynamics. This kind of differentiation is only determined by what is changing, not how it is changing. The actual dynamic classification of flows starts just within each of these four categories, where the flows are classified according to their own dynamic nature, according to the nature of movements rather than the moving object itself. Let's try to make such a classification. The main elements of changes in equity can be easily identified. They are determined by a set of three corresponding statements within the financial reporting: the statement of profit or loss, the statement of comprehensive income, and the statement of changes in equity. Besides, the structural changes should be mentioned when the total equity value does not change, but its constituent elements change at each other's expense. One of the examples of structural changes is the conversion of accumulated revaluation surplus of an item of PPE into retained earnings at the moment of its derecognition or depreciation. Thus, the elements of equity movements are: first, profit or loss; second, other comprehensive income. I'm so tempted to make fun of this name, but I will not. Third, transactions with shareholders. Fourth, structural changes. The cash flows are also easily classifiable, since their classification underlies the presentation of the corresponding statement, and it is set out in the requirements of IS 7 Statement of Cash Flows. The standard classifies cash flows into those arising from operating, investing, and financing activities. For the sake of accuracy, we should have complemented these three classes of cash flows with the exchange rate effects, which are also the changes in value of money over a period. And so they are also the dynamic indicators required for arriving at the dynamic balance. IS 7 states that those changes are not cash flows. However, the standard requires them to be reported in the statement of cash flows in order to reconcile the amount of entities' cash and cash equivalents at the beginning and at the end of the period already reported with the amount of cash flows for the period. It's IS 7 paragraph 28. Such changes have a certain degree of conditionality, since they depend on the presentation currency of the statements. In this context, we are not going to isolate the exchange rate effects into a separate class of money movements, having agreed upon their being included in operating cash flows in order to simplify the classification, as well as for purely aesthetic reasons to get a more elegant picture. Aside from the movements mentioned, there are structural changes occurring in money that do not alter the total amount of cash and cash equivalents. An example of structural changes is the receipt of cash by the cashier from the current bank account. Thus, the elements of money movements are: first, operating cash flows; second, investing cash flows; third, financing cash flows; fourth, structural changes. Well, as for the classification of movements of assets and liabilities, The situation is more complicated because such indicators are not the subject of special statements and scattered across notes. Meanwhile, such classification can be built on the basis of solution for two main problems of accounting policy: recognition and measurement. In order to appear in accounting records, an item of asset or liability must be recognized. Recognition issues are paid close attention in the accounting standards. The standards include specific sets of recognition criteria for various kinds of assets and liabilities. As soon as these criteria are not compiled with any more, the item gets derecognized, written off. Examples of asset recognition are purchasing, self-constructing, expenditure incurred, acquiring through business combination, contribution from shareholders, granting loans, providing goods, works and services, and others. Examples of asset derecognition are selling, losing ability to generate economic benefits, financial leasing, repaying debts, and others. Examples of liability recognition are getting loans, receiving goods, works and services, taking as a result of business combination, forming tax base, constructing a facility which implies future decommission costs, and others. Examples of liability derecognition are repaying debts, fulfilling through provision of goods and services, transferring to another entity with selling the related asset, cancelling due to expiration, and others. Another class of changes in assets and liabilities relates to changes in the carrying amount of the items recognized earlier. Such changes can be referred to as revaluations. Most often, the revaluation is performed by adjusting the carrying amount of the item to its fair value. Other examples of revaluation are impairment, doubtful debts loans, recognition of actuarial gains and losses, etc. In some cases, revaluation substitutes the recognition, like in the case of biological assets or derivatives. In such cases, the recognition is performed by changing a zero value to non-zero. Yet another class of changes in assets and liabilities falls in between recognition and revaluation. It includes the present changes in the value of asset or liability due to the passage of time, which take the form of progressive accruals made on a systematically recurring basis. Examples of such accruals are non-current asset depreciation, amortization of discounts on provisions, accruing interest on debt financial instruments, etc. For example, the depreciation of PPE reflects the asset's gradual loss of ability to generate economic benefits. From this standpoint, it characterizes the recognition of an asset. It looks like its gradual disposal. On the other hand, depreciation reflects the decrease in value of the asset, the same way as its impairment. So, in this context, it characterizes its evaluation. The same about debt instruments. On the one hand, the accrual of interest or amortization of discount means the emergence of another debt. This part is often paid prior to the main amount. And from this point of view, it characterizes recognition of the item. On the other hand, such accruals change the value of an existing asset or liability, and from this point of view, they characterize its evaluation. I do not attempt to provide a theoretical justification for assigning such accruals to recognition or revelation. Anyway, they have signs of both. The specific nature of such changes in assets and liabilities deserves to be placed in a separate class of flows. Let it be titled amortization. In addition to the above-mentioned changes, structural changes occur in assets and liabilities when they are reclassified from one class to another, while the total amount of assets or liabilities remains unchanged. Examples of structural changes in assets are reclassifying investment property as property, plant and equipment, reclassifying PPE as non-current assets held for sale, and others. Examples of structural changes in liabilities are reclassifying long-term debts as short-term, reclassifying employee benefits provisions as accounts payable to employees, and others. Thus, the elements of movements of assets and liabilities are: first, recognitions, including derecognition; second, amortizations, including depreciation; revaluations; and fourth, structural changes. So, we have identified 16 classes of flows, including 4 groups of 4 classes, with each of the groups reflecting changes in each of the 4 elements of static balance. Well, what's so remarkable about these 16 classes of flows? They present a complete list of the entire accounting dynamics. There are no other duration elements in financial reporting. Of course, we can differentiate them into the larger number of classes, distinguishing the new types of flows within these 16 classes. But we wouldn't be able to come up with any new types of accounting flows beyond this list. And now, having such a complete list, we can build the dynamic balance. It is a natural extension of the static balance because each of the flow indicators represents the change of a respective stock for the period. The stock balance is conditioned by defining one item through all the others. In the present-day accounting, this is how equity is determined: the residual interest in the assets of the entity after deducting all its liabilities. Conceptual Framework, paragraph 463. The definition guarantees that the pans of the static scales are balanced at any time, and it is also what must guarantee the pans of the dynamic scales are balanced for any period of time. There are inflows and outflows in each class of flows. For example, income and expenses that form profit, contributions from shareholders and distributions to them, cash inflow and cash outflow, recognition and derecognition, etc. If we distinguish inflows and outflows in each case, then the total number of dynamic classes is doubled from 16 to 32. But it's fine to ignore the structural changes as they do not cause changes in the value of elements of the static balance: money, assets, liabilities, and equity, and are obviously balanced pairwise. Inflow is invariably equal to outflow. Thus, we consider only 24 relevant classes of dynamic indicators instead of 32. These 24 classes of flows are neither equal to each other pairwise nor in any other local combinations. But if they are considered all together, they should be mutually balanced. It is easy to prove mathematically. Now let's take 2 arbitrary dates, I and j. We assume these dates are the beginning and the end of the reporting period. The dynamic indicators represent changes in respective elements of the static balance between the two chosen dates. Delta Mij equal Mj minus Mi. Delta Aij equal Ij minus Ai. Delta Eij equal Ej minus Ei. Delta Lij equal Lj minus Li. The static balance is struck at any date by virtue of the definition of equity. Therefore, both equations are satisfied. Mi plus Ai equal Ei plus Li, as well as Mj plus Aj equal Ej plus Lj. By subtracting first equation from the second, Mj minus Mi plus Aj minus Ai equal Ej minus Ei plus Lj minus Li. We obtain delta Mij plus delta Aij equal delta Eij plus delta Lij. Since the dates I and j were chosen arbitrarily, the resulting equation is valid for any period. Delta m plus delta a equal delta e plus delta l, quod erat demonstrandum, which was to be proved. All that remains for us to complete the construction of the dynamic balance is to replace the letter symbols in the equation denoting the changes in the instant items MAEL by any signs denoting the duration items themselves. I doubt I'll be able to come up with the original letter symbols for all 24 items. Let's make it easier. Let's take the same letters MAEL but lowercase ones, with numbers 1, 2, 3, 4, 5, 6 for each class of flows. The odd number indicates inflow and the even number indicates outflow. For example, E1 stands for income, E2 for expenses. E3 means positive OCI, E4 means negative OCI, which means other comprehensive expenses. E5 means shareholder contributions, E6 means dividends and other distributions to shareholders. And in the same way for other flows. A1, A2, A3, A4, 5, 6, M1, 2, 3, 4, 5, 6, L1, 2, 3, 4, 5, 6. We replace the terms of our equation with these symbols. On the left side, instead of delta M, we write M1 minus M2 plus M3 minus M4 plus M5 minus M6. Instead of delta A, we write A1 minus A2 plus A3 minus A4 plus A5 minus A6. On the right side, instead of delta E, we write E1 minus E2 plus E3 minus E4 plus E5 minus E6. Instead of delta L, we write L1 minus L2 plus L3 minus L4 plus L5 minus L6. Now transfer the terms in the equation with the minus sign in the opposite side so that all the terms of the equation turned out with the plus sign, and that our balance looked like the equality of two sums. M1 plus M3 plus M5 plus A1 plus A3 plus A5 plus E2 plus E4 plus E6 plus L2 plus L4 plus L6. This is the left side, so the right side. M2 plus M4 plus M6 plus A2 plus A4 plus A6 plus E1 plus E3 plus E5 plus L1 plus L3 plus L5. Voila! This is the complete dynamic balance equation. To make it more like what we used to call balance sheet, we'll go back from abstract mathematics to real life and present the terms of this equation as a list of accounting entries with their real names, On the left side of our dynamic balance sheet, we have operating cash inflows, investing cash inflows, financing cash inflows, asset recognitions, asset amortizations, asset revaluations. We assume that the words amortization and revaluation both mean an increase in the value of item, and the words depreciation and devaluation both mean a decrease in the value of item. So we continue the left side. Next we have expenses in P&L, other comprehensive expenses, OCE or whatever we call it. I would have come up with some more decent name for this phenomenon, but I do not want to take the bread out of its inventors. Well, next we have distributions to shareholders, liability recognitions, liability depreciations. I'm not sure if you've ever come across a liability depreciation, but theoretically it could be. If I remember correctly, the first exposure draft of IFRS 16 leases of 2010 proposed to apply depreciation of the lease liability by the lessor. However, then, because of the lobby of leasing companies, lessor's accounting remained unchanged, and all the ideas of that project, whether bad or good, were abandoned. Speaking about the existing standards, the IFRS 15 revenue from contracts with customers, Appendix A, the third term, introduces the concept of contract liability. There are no rules for accounting of this newcomer in the standard. So, in the case when the condition for the performance of this liability under the contract is simply the expiration of time, depreciation is probably the very method that should be applied for its accounting. Meanwhile, we have to finish our list. The last line in it is liability devaluations. This is a complete list of lines on one side of the dynamic balance sheet. Now, what do we have on the opposite side? Operating cash outflows, investing cash outflows, financing cash outflows, asset recognitions, asset depreciations, asset devaluations, income in P&L, other comprehensive income, contributions from shareholders, liability recognitions, liability amortizations, liability revaluations. That's it. The dynamic balance sheet is completed. Well, now you probably think that I want to offer this dynamic balance sheet in addition to the static one and force entities to include two balances in their financial statements instead of one. No way. Dynamic balance sheet is, first of all, a methodological basis, a starting point for solving various accounting issues, including both theoretical and practical. You yourself have probably come up with a couple of ideas on how to use it. Dynamic balance sheet will help everywhere in determining the optimal structure of financial statements, in the formation of a list of required accounts, in the managing of entries on these accounts, in the formalization of the conceptual framework for financial reporting, in optimizing the information disclosed in the reporting, and even in establishing adequate requirements for the recognition, measurement, and presentation of particular elements of financial statements. I would be glad to tell you how the dynamic balance sheet can be used in different aspects of accounting. However, not now, but in other videos.